Are you ready for a quickie? Welcome back, YouTube universe, to another session of Dividend Quickies. It's me, ET, and these videos are designed to give you some quick facts, the pros and cons, all up under 6 minutes. In today's session, we're going to talk about REITs, real estate investment trusts. Now, these here are investment vehicles designed to help give you income, the owner of those REITs income. All right, so let's get into it. The way I'm going to do this, I'm going to go over the pros, the cons, and I'll talk very briefly about what I have in my portfolios. The pros for owning a REIT: it's an alternative to buying property. If you decide to get into the real estate game, you really have about a couple of different options. Two most common options are to actually go out and get the real estate and then go ahead and put your tenants in it and collect the rent that way. Or another way that you can do this is you can actually own a REIT. The key thing with the REIT is that there is not a large capital expenditure and you don't have to deal with tenants. Also, another key pro to the REIT is that it is truly passive income. Once you own these REITs, guess what? Your money is coming, your dividends are coming to you on a regular basis. Most of the REITs are going to be on a monthly basis, but there are a few out there that has quarterly. Regardless, you're getting paid on a regular basis. All REITs fall up under the 90% rule. And what that 90% rule is that by law, these companies must pay 90% of their taxable income out to the shareholders. And that's the reason why you get a much higher dividend yield than, let's say, owning a stock. Now, also investing in a REIT is you're investing in real estate that acts like a stock. In other words, based upon the platform that you're on, whether it's TD Ameritrade, Robinhood, Charles Schwab, Fidelity, E-Trade, it doesn't matter. Whatever your platform is, you can go in, buy those REITs and have it on your platform just like you do a stock. You don't have to get an agent, go look at properties or anything else like that. That's all being done for you and it's being managed for you. And it's just that easy, just like buying a stock. And I would recommend that anyone who's trying to increase and build a dividend portfolio that you set it up on a DRIP. And I love this. A DRIP is nothing more than a dividend reinvestment program. You know, this acronym here, it tells you exactly what it is. Your dividends are reinvested into that REIT. You buy more. In other words, the money that they normally will pay you, if you set up a DRIP, it'll reinvest that money back and buy you more shares. Could be fractional shares, but who cares? Something that you didn't have to pay for. It's starting to pay for itself. Great way to help build up your portfolio. Now, I highly recommend that anyone who is building or trying to start building a dividend portfolio, you do it under either the Roth, if you qualify for it, or a traditional IRA. If you do it under a Roth, it's tax-free. Traditional IRA is tax-deferred. And you'll see why I say that in just a second. So let's talk about the cons. The cons. Number one con right off the bat, it is interest rate sensitive. As interest rates go up, people normally transition out of REITs and go into bonds. As long as interest rates are down, REITs are going to be more popular than bonds. So it's interest rate sensitive. Keep that in mind. Also, the income that you receive from the REITs, the dividends, it's taxed as ordinary income. That's why I say if you're going to set it up in one of these two. If you qualify for a Roth, set it up there. You're not going to pay any taxes on it. Don't worry about it. It doesn't mean anything. All right. If you don't qualify here, or if you're starting to build your positions in a traditional IRA, that's great too, because it's tax deferred. You won't pay taxes on that until you start taking money out of that traditional IRA. Now, I have a total of 3 REITs in my dividend portfolio. I have O, Realty Income. They specialize in commercial properties. For example, 7-Eleven, Walmart, Sam's, and Walgreens. You have LTC. LTC Properties, they're in the healthcare. They work with healthcare properties. Then you have IVR. IVR, Invesco Realty. What they work in is their mortgage. They work with the loans. Their mortgage, the loans, that's their specialty there. So hopefully you find this information useful. If so, make sure that you hit that like, subscribe, and notification button. With that being said, guys, I will see you on the next quickie. Take care.